There we go. And I thank you, Julie, for coming in tonight. I greatly appreciate it. And I guess I say tonight it's early. Cindy got this one booked at 4 o'clock Eastern Standard Time instead of 7. And that's great. I love it being flexible, and I love everybody that's coming here and joining us, even this different schedule. So we greatly appreciate it. And if you get a chance sometime tonight, throw in the chat. What do you think about the time frame? Do you like that 4 o'clock Eastern Standard Time, or do you like it later? You want it earlier, different day of the week? Just kind of give us a little feedback, because as we're booking things out and the list is getting quite long, sometimes we get a little thin on guests, but right now we are probably 6-8 weeks deep with people that we want to add.
We are.
Just let us know what works for y'all, and how much is too much. Is 2-3 times a week okay, or does that get to be overload? So if you give us some feedback, we greatly appreciate that. Again, welcome to Creative Real Estate University. Welcome to our Facebook group as well as our YouTube channel. And tonight we have a special guest, Julie Hayes. She's going to talk about infinite banking. And this is a concept that Cindy brought to me because it's totally foreign and alien to me, I must say. So when she explained it to me, I'm like, no, really? She says, yes, we have to hear from Julie and hear all about it. So Julie, give us a little background about yourself first. Tell us who you are. Okay. Tell us how you got, from that high school kid hanging out in class going, what am I going to do with my life, twirling around the seat, to where you're at now, and how'd you get into infinite banking?
Okay, well, I have that in the presentation. So you want me just to kind of kick into the presentation and share my screen?
Whatever works for you. Yes, ma'am.
Okay, I'm going to go ahead and share my screen. Let's see if I do this the right way. Is it going to cooperate? There we go. Okay, so a little bit about me. So I have spent 30 years in corporate America. That's where my life started. I'm from Dallas. I'm a native Texan, which we're becoming more rare and rare as the day goes on. So, but native Texan, and I spent 30 years in corporate America in strategic finance and technology operations. And so finance has been in my blood forever. My degree is accounting. So I've learned quickly that I did not want to live my life by calendar, so accounting went out the door pretty quick. And but love finance and love everything about that component. About 5 years ago, I decided to leave corporate America. I was just tired of the rat race. 70-hour work weeks and 120-person team was just, I'd had it. I was ready to do something else with my life. So left corporate America, took a year off. And just kind of thought about what I wanted to do. And, everybody wants to do insurance, right? I mean, how could that not be the answer? But somehow that ended up it came into my life, and I absolutely loved the infinite banking strategy. And so we decided to open an insurance brokerage and have been working with small business and families ever since. And it's such a great strategy that can help so many people achieve really good financial goals. So I love it. So that's how I got into it. Honestly, my daughter got me into it. So I just love being able to spread the word and help introduce it to a lot of people. So it's exciting. I am a Nelson Nash practitioner. So Nelson Nash, they call him the grandfather of infinite banking. He has an institute where a number of agents will go and learn in detail about infinite banking and how it works and how to implement the strategy and how to support our clients. And so I am a practitioner of the Nelson Nash Institute, which I'm pretty proud of. So that's awesome. So our agency. So we have a full insurance brokerage. We do property and casualty as well as life. And I don't do health. That's the one thing that we don't do. But we have some really great partners that we partner with on health insurance. So that's great. We can help our clients in a full range. But these two areas right here, the infinite banking solutions and the debt elimination solution, both of those leverage the infinite banking strategy. So that strategy that we talk about today, those are the two solutions that we support leveraging that. So who are we really, right? So we are a business that loves to be a trusted advisor of our clients. We want you to reach your financial goals and to become financially independent. And so we do everything we can to work with you, your CPAs, your financial planners, to make sure that you have a holistic plan in place. Our goal is to serve our clients in the best possible way with your best interest at heart. And we work with it with integrity, enthusiasm, and compassion as we go through that. So we really bring our best selves to the table when we work with our clients. So what's the problem? What's the problem that we're trying to solve with infinite banking? And I put this in the view of real estate investors more so than just in general, but it's really a four-pronged approach, right? So financial, the cost of capital is increasing. Everybody hears every day that the Feds continue to raise interest rates, and that creates a challenge in the capital market. So as we're asking ourselves, how are we going to fund our real estate deals? What does that look like? Risk, and from a risk perspective and being competitive, as I have learned coming into the real estate investing world, if you do not act fast, you are probably going to lose the property that you're going after. Being able
you definitely know that firsthand, right?
I do. So being able to act quickly and have the cash available and liquid for you that will allow you to act quickly is important. Expenses, the cost of supplies, the cost of contractors, that's going up as well. So having capital to be able to fund those things is important. Being able to show that you have reserves in place is important in the real estate investing world. And so your policy can help you with some of those. Also, your exit strategy, right? I don't know of many people that want to work for the rest of their lives. Although my husband says I will never retire because I can't sit still to save my life. But most people don't want that, right? And so what is your exit strategy? And your infinite banking policy can help you in that exit strategy and support your other financial portfolio tools that you have in place. So those are things that we're trying to solve with the strategy. And guys, if anybody has questions along the way, just interrupt me. It's all good, but I want to make sure that your questions get answered. But along that way, right, I always talk to my clients about the end in mind. Let's work from the back forward versus from today on. And so where do you want your last day or your last years, kind of spent? Do you want them at the beach, at the mountains, wherever your happy place is? Or do you want to be a greeter at Walmart? I know I want to be a greeter at Walmart. That is my goal, but I'm not sure about everybody else. So with that in mind, as we go through the trajectory of life, right, everybody is in a different stage. And so leveraging the infinite banking strategy across each stage in life, there is a role that it can play, no matter where you are. Much like that in your business, we have different trajectories on where we all are with our business, right? We might be in the incubator stage and just thinking about what we're going to do. Mm-hmm. We might be in a growth stage and we need to diversify. We want to add products. We want to add additional kinds of properties, whatever that case may be. But along the way, your strategy, your infinite banking strategy can help you attain those goals. So as we talked about, what we heard Kelton talk about at the session that many of us were in, was that there are several people that have leveraged this strategy for a very long time. Infinite banking has been around for over 200 years. The earliest example that I know about, that I've read about, is J.C. Penney. J.C. Penney, during the Great Depression in the 1920s, leveraged his whole life insurance policy to pay payroll to keep the J.C. Penney store active and alive during the Great Depression. That's the oldest example that I have, and how long this has been around. But Disney started Disneyland with his policy. Doris Christopher, who started Pampered Chef, used her policy, and then, interestingly enough, sold it to the man on the far right, to Warren Buffett, for over $6 million. So a little bit of a good investment on her part. And then, of course, we know the story of Ray Kroc, and he used his policy to pay payroll as well to build out the McDonald's chain that we all know and love, the Golden Arches. And so, it's been around a long time. I would love to see one of your pictures up here in a future presentation of how you've used your policy to succeed in business. So let's make that happen.
Sounds good, Julie.
I know.
I think the Walt Disney is the very famous story of infinite banking, right? That's the
Yeah,
one I've heard
he's
before.
one of he's one of the most known stories about it. But it's just unbelievable. But typically when you read about the Rockefellers is a family that has leveraged this strategy, and they're one of the most well-known families that talk about infinite banking and how they leverage that to build generational wealth across their family, and it's how they keep their family, kind of legacy and wealth intact. Because every time a child is born in the Rockefeller family at 18, they get a policy, period, and that's how they continue their generational wealth. So it's a pretty powerful tool. But the product itself, so the infinite banking strategy is built on the whole life insurance chassis. Okay, so that's the product that it uses. It doesn't use just any whole life though. So these whole life policies can be layered. And what that means is that we layer term insurance within the wrapper of the whole life product. And we do that because the whole goal is to reduce the cost of insurance as much as we can, so we can push more cash into your cash value. Okay, so we're trying to reduce that cost of the insurance, which is the necessity for the policy, to get more cash in your cash value. Again, it's a very tested product. It's been around for over 200 years. And it's unique to every person. Because it is an insurance policy, it's based on your age, your health, any type of medical underlying issues that you might have. So that really is the basis, the starting point of where the cost comes from. Now, there's options if you are uninsurable because of a medical issue, or age might make the cost prohibitive, right? So there's options, and we have workarounds, and we can talk through some of those. It is guaranteed growth. So you have significant tax benefits and guaranteed growth in the product. If you research this at all, you're gonna read two camps. You're gonna read a camp that thinks that an IUL, which is an indexed universal life insurance policy, is good for infinite banking. And then you're gonna have the traditionalists who say whole life is the way to go because it is guaranteed and it is very secure in its approach. IULs are indexed, which means they are built around the stock market. So you continue to be involved in the volatility of the stock market, which that's not really the premise of infinite banking. However, we can write an infinite banking policy leveraging an IUL. If the client just insists that that's what they want, we can do that. We just have a different type of education to give them on how an IUL policy functions than a whole life policy. Okay. Any questions about that before I go on? Okay, Jane, you'll have to help me if there's raised hands, because I won't be able to see all that, I don't think.
Yep, I'll keep an eye on that.
Okay.
I don't see any. And then,
Okay.
again, Julie, being tied to the stock market, when things are good, of course, they all tout it and how great it is. But the truth is, there's still volatility, especially in times right now. There's some uncertainty that we're heading into.
Exactly. Yeah, and that's what we're trying to alleviate with the infinite banking strategy, right? Is that volatility. And we'll talk in a little bit about your entire financial portfolio and how there's different tools there and to leverage those in different times. So we'll talk about that in a little bit. But the infinite banking strategy is really your chance to be the banker, the borrower, and the depositor, right? Being all three of these pieces really is what eliminates some risk for you. It allows you to be in total control of your money. It also allows you to leverage your money more than one time, right? We'll use that dollar in more than one way. And so we'll get to an example on what that looks like in a moment too. But this is the power of the infinite banking and the essential premise of it. Now with this comes great power, right? And so with that great power, we have to be disciplined in the approach and how we use it. I will tell my clients, and only you know and can be honest with yourself, if you cannot be disciplined with your money and with this approach, do not do it. It's not for you, right? Because borrowing against your policy and paying that back and doing that the same way with the same diligence you would if you borrowed it from a financial institution, you have to implement that same strategy to be successful in infinite banking. And so if you struggle with that, if that's a challenge for you, then I think we should talk about some other options, not this one. Just I'm always going to be real transparent, real honest about this approach, because I don't want people to get put in a bad position. So that's just some thoughts about that. So the power of compounding interest, we've talked about this and the just absolute strength of it. You know, Albert Einstein preached about this for a long time. And everybody who understands compounding interest will earn it. Those who don't will pay it. It's the way that it goes. So in this example, Michael, he saved $1,000 a month from the time he turns 25 to 35. Okay, so he invested $1,000 a month for that 10-year window. Okay, when he was 25. After that 10-year window, he didn't invest anymore. He just let it grow. Okay, so we see that he is up above 1.5 million. Jennifer did the same thing. She invested $1,000 a month for 10 years at the age of 35, and then left it alone, right? And so you see the impact of starting that investing 10 years later. Mm-hmm. Sam did the same thing. It's just he started it at 45. Okay, and so it's amazing that the exact same $120,000 investment and how it grows with compounding interest over time, right? And the impact it can have. That's the value of what we're talking about here. Okay, so let's take an example. This is a very, very known example for all of us. We've all had to buy a car. We've all had to borrow from a bank to buy a car. Okay, so this is the traditional example of buying a car. The assumption is a $95,000 car at a 7% interest rate for a 6-year loan. Okay, that's our example. So over that 6 years, you will have paid $95,000 for your car, as well as $22,000 in interest. So you actually paid $117,000 for that car, not 95. Okay. At the end of the day, at the end of that 6 years, you have outlaid $117,000, and you have a car that is now depreciated and is worth $60,000. Okay. That's the example we have all lived and all experienced. So let's look at that example through the lens of an infinite banking strategy. Okay. So same example, $95,000 purchase price. Let's assume we're going to charge ourselves 7% interest and at a 6-year loan. So we're going to pay ourselves back over 6 years. All right. So again, the same $95,000, you're borrowing that against your policy. And you will, because you're borrowing that against the policy. Now, this is the structure of how a loan works from an infinite banking policy. You are not taking the money out of your policy. You are borrowing it from the general fund of the insurance company, and your policy is collateral to them. Okay, so it's a collateralized loan from the insurance company. So you are paying interest to the insurance company. Okay, right now those rates are at about 5%. Okay, and so in this example, you are paying $95,000 of principal back to yourself, and then you are paying 12% interest to the insurance company. Okay, now this is where the benefit of the policy comes. Your entire cash value is still in your policy, and you are still earning compounding interest on that total value in your policy. So over that 6-year window, you have earned $19,000 in compounding interest. Okay, and so you are netting a positive $7,000 on that 6-year loan. Okay, hopefully that makes sense. And so at the end of 6 years, you have paid $107,000, $95,000 back to your policy, and $12,000 to the insurance company, and you grew in your policy by $19,000. So you have the car, you have the automobile after 6 years depreciated, worth $60,000, but you also have $114,000 back available to use again in your policy. Okay, so the $114,000 is the 95 plus the 19. Okay, so that's back in your policy to use again. That is how infinite banking works. That is the power of the compounding interest on your total cash value while you use that money in a different way. Okay, now let's think about this in
Julie, just one more time. The 95,000 came from
in the infinite banking example.
Yes.
So the infinite banking example is, this assumes that you have $95,000 available to borrow against
Yes.
your policy. Okay, that's in one assumption. But you're borrowing the $95,000 from the general fund of the insurance company through a collateralized loan of your policy. Okay.
Got it. Okay.
Okay. And so this is just a summary of what we just talked about. So let's assume that we're going to use this in the real estate world. Okay. So instead of spending $95,000 on a car, let's assume that the purchase price or rehab costs or closing costs for a property, right? And you're going to do the same thing that you just did with the 95,000 car example. You're going to borrow that, from your policy, and then you're going to do your property and you're going to flip it, and then you're going to sell the property and get your proceeds, and then you're going to use those proceeds to pay back your loan plus whatever you have left from that, right? So that's one example. Another example would be if you need to have carrying costs and reserves, shown to prove to a lender that you have those reserves for your property, your cash value in your policy can be used as those reserves, right? That cash value is considered an asset. It's liquid cash to you. So it is an asset in your valuation of your net worth. It is an asset when you go to a bank to borrow money if you need to use a lending institution, or it can be considered, another asset for your reserves with another lender from a property perspective. An additional way you can use it is to borrow it and do a private money lending scenario to where you are earning about 10% plus on that money while it's earning in your policy. So you're double earning on that money. And then when you get the loan back from the borrower, you just simply pay your loan back against your policy. Okay. And then you have the proceeds from the interest that you earned from the borrower, as well as your compounding growth. Does that make sense to everybody? Yeah. Okay. So those are some examples.
So Julie, just a quick question.
Yeah.
So, and maybe it's an oversimplification on my behalf, but it's very much like a self-directed IRA, but instead of using the IRAs to do the investments, we're using our whole life insurance policy, and it's cash value. Is that correct?
It's very similar, yes.
Yes. Okay.
Yeah, it's just that in this example, you have a death benefit as well, and so in that instance, if something were to happen to you, your beneficiaries would benefit from a tax-free death benefit, along with you leveraging that cash during your lifetime. Okay. Okay. So the process. Let's talk a little bit about the process in doing this. So to kind of go soup to nuts to get a policy in place, the first step is that an agent will ask some general demographic questions. Those questions are very simple. It's your birth date, it's your height and weight, it's do you take medications on a regular basis, do you have an underlying medical condition like arthritis, asthma, have you had a stroke, have you had a heart attack, do you have diabetes, any of those types of things. And then have you had any surgeries in the last 5 to 10 years? So those are the basic questions. The reason we're asking those questions are, again, it's an insurance policy. The underwriters want to know high level up front, are there any major issues? There are conditions like lupus, Parkinson's, muscular dystrophy, those are uninsurable. The cost of the insurance would be so prohibitive that it just would make no sense to do that, right? So we are trying to glean, do we have a situation like that we need to then talk about what are our options? What are some workarounds that we might have, okay? There's other conditions, like I can speak to Crohn's disease because my son has it. Crohn's disease will be a table, right? His cost of insurance will be higher than my daughter who doesn't have a medical condition, right? He's insurable, but it's just going to cost him more, right? So we're trying to understand that situation up front. Then with that, the insurance agent goes and works with the carriers to build illustrations. An illustration is an example of what your policy would look like based on the medical and questions that we just asked, plus how much you want to invest in a policy, okay? And so during the real estate session, when Kelton was talking about this, there's one thing that I want to clarify. he talked about that you couldn't use your policy for like 1 to 2 years, right? That scenario is if you are paying your premiums monthly and that's all you're doing in your policy, all right? The commercial clients that I work with, the small business clients, typically want to leverage their policies immediately. And so what we do, because we teach businesses how to run their payroll through their policy, how to run their capital expenses like machines that they have to lease, their lease on their building, things like that. We teach them how to run that through their policy on a monthly basis. So they want to use that starting immediately. So what we'll do is we'll drop a lump sum at the very day one, so then they can borrow that against that 7 days after their policy is active. Okay, so there's a way to start leveraging your policy immediately, and then there's other ways that you want to wait a couple of years to really let it germinate. I'm going to say let it grow a little bit before you start to use it. And again, everybody's situation is different. Every policy is unique, so that's all fine. We just have to have that conversation on what's your goal, how do you want to use it. Additionally, there's things like real estate, realtors, people that get bonuses on a quarterly basis or biannually basis. They want to be able to load some of those bonuses or commissions into their policy. So we have to build the policy with a structure that it can handle those big influx of cash when they want to do that, right? They're not contractually obligated to do that, but we have to build it in a way that it can handle that. Okay, so that's when Kelton says that you need to work with somebody who understands how to build these policies, he is 1000% right. Because if you don't know that you have to think about those questions and know about that structure, then you can turn your policy into a non-tax advantage policy. And what happens, let me explain what that does. So the insurance company will run a test every year. Okay, it's called a 7-pay test. And that 7-pay test is evaluating the ratio in the balance between cash and death benefit. That ratio has to stay within a certain range, or if it gets out of balance, that policy then becomes an investment tool and not an insurance policy. Okay.
Okay.
If it becomes an investment tool, it's called what we call a MEC, a modified endowment contract. If it becomes a MEC, and once it becomes a MEC, it is a MEC from that point forward. It cannot revert back to an insurance policy. Okay. So we do not want that to happen. If that happens, all of your growth and all of your income are then taxable. Okay. It becomes
all the benefit was just lost forever. Yeah.
Yeah. So your benefit of doing this, your benefit of the tax situation is lost if it becomes a MEC. We don't want that to happen. Okay. So the structure of this policy is very important to manage that situation. Okay. So the illustration
Julie?
helps again.
Julie, there was a question here from Martha.
Okay.
She has a 401k from her previous employer. Martha, you can, just so you know, you can use that 401k to transfer it to a self-directed, but she wants to know if she can use that money to purchase a policy.
Okay. So that question is later in the deck, but I'm going to go ahead and answer it. So can you? Yes. Here's the implication for doing so. Okay. When you take a qualified retirement account, an IRA, a 401k, a 403b, any of those scenarios, when you take that and you want to transition it to a non-qualified retirement account, which an insurance policy is a non-qualified retirement account, okay, then if you are 59 and a half and younger, then you will take a penalty for doing that, and you will have a tax implication for doing that. Okay, so I am not going to sit here today and tell you that you cannot or you should not. That is, every decision like that is individual, and what your situation is needs to be evaluated to know if that's a good decision or not a good decision. Is that helpful?
Yes.
Right, I'm hoping that answers the question. If not, we're going to talk about that a little bit later. So then we run the illustrations And then we come back, we review those, we'll tweak them. I want to put more in, I want to put less in, I want to see this different, I want to, add more in year 5, whatever, right? We'll tweak that illustration. Then when we get that the way that you want, then we do an application. And I'll warn you now, the application takes a hot minute, okay? It is several questions that we're going to answer. It's going to take at least 30 minutes. Just be prepared. And then once we do the application, it takes 2 to 6 weeks to get approved. There is an in-depth underwriting situation that happens at the insurance company. They're going to dig into your medical background. They're going to get your prescription background. So by all means, don't fib and don't withhold when we do the application. The more that you tell them up front, the better it's going to be. If they uncover on the back end, they think you're hiding some other things and they're going to dig even deeper. Okay, so just FYI. Once the application is approved, then we just finish the paperwork and the policy is enforced. Okay, once it's enforced, that means that if you did a lump sum in upfront, within 7 days, you can then take cash out or take cash against your policy within 7 days. When you tell the insurance company that you want to take a loan, you either call them or do it on their online app. It depends on how much you want to take out. It takes about 5 to 7 business days, and that cash will just hit your bank account. They just transfer it into your bank account, okay? And then you use that for whatever you want. You use it and you pay yourself back, all right? And then I do an annual review, at least an annual review with every client to talk about, is their situation changed? Have your goals changed? Is there something new that's come up on the horizon? Do you have a new business? Did you sell your business? Whatever the case may be, right? But we want to make sure every year that your policy is operating the way that you want it to, all right? So that's the kind of the process to get a policy in place and what you're going to go through during that process, okay? So questions to consider. We just talked about some of these. So should I cash out my investment to get an infinite banking policy? So we just talked about that and the implications in doing such, right? And so that's one thing. Who should purchase policy? Me, my business, or me? Okay, let's talk about the benefits of each of these. Okay, so if you buy a policy and you want your business to leverage that cash, you purchase the policy, you take a loan, you then loan that to your business. Okay, you are giving your business a personal loan. You charge your business interest. Okay, by doing such, that interest that you're charging your business is a tax deduction. Okay, just like if you take a loan from a bank, just if you take a loan for something else in your business, it's a tax deduction. So that's a benefit to your business.
Julie, are you saying that if you take if the policy is under you personally, then your business is borrowing from you personally? Okay, got it.
Yeah. Now let's say that you want the business to purchase the policy. So under tax code 162, that's the executive right tax code. As the executive of your business can purchase a policy for you that then becomes like a bonus program for you, okay? And the death benefit portion of your premium is then a tax deduction for your business. But you have to show that as income on your personal tax return. So if you have an LLC, an S Corp, a sole proprietorship, that becomes a wash. Your income, a tax deduction for your business. It essentially washes out, okay? So really then what you're doing is you're paying for the cash portion of your policy, not the death benefit portion of your policy.
I never thought about that way. I knew it was a business expense, so to speak, and good for the business to do it that way. But the flip side is you're receiving that as a benefit, so it's a taxable event on your personal side. Yeah.
Right. So there's pros and cons. There's not really cons, but there's just different reasons why you would do it a little bit differently. And so those are just things that we should talk through, or whomever you're going to work with, you should talk through, right? On what that looks like.
Julie Tina has a good question.
Sure.
And the one that, if you, in your previous example, let's say there's $100,000 you put in to your policy. when it's funded and active, is that $100,000 all available again, or is there a percentage or a fraction of that? How does that work?
So we're going to go through an example and I'll show that to you.
Okay, thank you.
Okay. Yep. Give me a minute on that one. So then what if I'm uninsurable? We talked about some reasons why that might be, right? So then we start to look at, do you have a business partner, right? Can we do a key man policy where you can operate this as a key man for your partner? Do you have a spouse that might be insurable? Do you have a child that is 18 or over, right? Those are all ways that we can write a policy on one of those individuals. You are the owner, or the business is the owner of that policy. And then, so you manage the cash value. You would do it just like if it was your policy. And then you can either make a trust the beneficiary. Infinite banking policies work beautifully with trust, absolutely beautifully. And so the trust can be the beneficiary, the trust can be the owner. So say you're the owner, you pass away, you leave the trust as the owner of the policy, and then your trust is going to manage that cash value, right? If it's on someone else, or the death benefit will get paid to the trust, and then the trust has rules, has designations on what to do with that tax-free death benefit. Okay, so trusts are beautiful, but if you're uninsurable, we look at all of those options, right? If you don't have any of those options and you have a child under the age of 18, that is when we start to look at an IUL. Okay, because we cannot write an infinite banking policy on anyone younger than 18. You could absolutely write a whole life policy on someone under 18, but not an infinite banking policy. Okay, so there's options there, there's workarounds. We would just need to look at each one of those individually and see what we do, what works best. What if I don't have dependents? Okay, so if you don't have any dependents to leave as beneficiaries to, again, a trust is a beautiful thing. That trust can then donate that to a charity. It can, I mean, you can do multiple things with the benefit if something were to happen to you and you don't have dependents. I would tell you, you should have a trust in that scenario. If you don't have one, you should absolutely get a trust if you're going to have an infinite banking policy. I would say period, but specifically if you don't have any dependents. Okay. So just things to consider, things to talk through as you talk about your individual scenario and your individual policy. Okay. Okay, so some terms that I want you guys to be aware of and to know, okay, as you start talking about infinite banking or insurance in general, really, but infinite banking specifically, participating versus non-participating insurance companies. This is where we talk about mutual insurance companies versus non-mutual insurance companies. A mutual insurance company is a company owned by the policyholders, okay? We write infinite banking policies with mutual insurance companies, okay? Participating policies. The reason we do that is because participating policies are paid dividends by the insurance company. Those dividends are what help continue to build the cash value and the benefit of your policy along with your premiums, okay? And while dividends, we can't say that they're guaranteed because it's a dividend and it's based on the company's performance and it's based on, you know, their activity and the amount that's deposited by the policyholders. But every one of these companies has been around for about 200 years. They have consistently paid a dividend every year. And that is public knowledge. You can go research it. It's documented. They have done it consistently for over 200 years. So while we can't say it's guaranteed, historically, it's pretty guaranteed. Okay. But that's the difference in participating and non-participating companies. So just be aware of that terminology. Paid up addition. You're going to hear this a lot with infinite banking. Okay. A paid up addition is an insurance, it's extra whole life insurance coverage that's purchased by using the dividends, okay, with a PUA rider, a paid up addition rider. That additional coverage is then added to your benefit and it helps the cash value grow and it helps balance that cash to death benefit, right? It keeps that ratio in check as well. So that's something to be aware of. A reduced paid up, an RPU, is a contractual option that every whole life policy holder has the option to elect to have paid up insurance, reduced paid up insurance. So let's say you have a policy and you're paying your premiums, and at age 60, you're like, I don't want to pay any more money into this thing. I'm done. We will look at that, and we'll see what we can do with a reduced paid up policy, which means that some of your cash value or your dividend is going to pay up your insurance, right? It's going to pay up to the death benefit, and then you never have to pay another penny in, but your policy will still continue to grow with the dividend. Okay. It's just leveraging some of your current balance to get your policy paid up so you don't pay any more premium. Okay. That's an option that you will choose throughout your policy. It's not something you have to choose at the beginning of your policy. You can have an election to choose that throughout your policy. Okay. And then direct versus non-direct recognition. So direct versus non-direct recognition, this pertains to the dividends. Okay. So in a direct recognition company, when you have a loan out, right, then the company will look at two different dividend calculations for the amount that has the loan out and the amount that is still in your policy or not being activated. Okay. Every dividend payout has to be equitable across every policyholder. So don't think that that is a negative to you necessarily. It is just, it's a different way that they do the calculation of dividend payout. Okay. In a non-direct recognition company, regardless if you have a loan out or not, they have one dividend calculation. Okay. They look at the entire cash value of that policy, regardless if there's a loan out of it or not. So it's just two different ways that the companies look at things. Okay. And so it's just good for you to know which type of company is my policy with. Are they a direct recognition company or a non-direct recognition company? Okay. So again, I just want you to be aware of the terms, understand that there's a slight difference. It's not a good or a bad. It's not a should I or a shouldn't I. It's be aware. Okay. Okay. So then really, this is the power of life insurance, right? You can build liquidity. You're increasing your cash flow. You are growing tax-free. I have to put tax deferred in there because if your policy becomes a mess, then it's tax deferred, but our goal is to keep it growing tax-free. We have compounding growth that's guaranteed. The tax incentive, depending on how you leverage your policy with your business. It's a huge exit strategy. So we work with a lot of dentists in our practice as well. And so we had a dentist that had her policy. We taught her how to run her payroll through it and some of her expensive machines that dentists have to have. She sold her practice about 3 years ago for $4.5 million. Her practice had essentially paid for her policy, and her policy was worth $7.5 million in cash value. So
Wow.
her practice, instead of walking away with $4 million in equity, she walked away with $11.5 million in equity from her business. Okay. That's the power of how this can help you with an exit strategy. Again, executive benefit and key man, those are key things that we can do with these insurances as well. So just, there's a lot of power here if we leverage the strategy in the right way, right? Okay, before we get to the example, the one thing that I want to talk about too is your financial portfolio. Okay, I am not a financial planner. I don't profess to be, but everyone has a financial portfolio, and there should be several components to that, right? When people look at a whole life insurance policy and the infinite banking strategy, I do not want you to try to compare that to an IRA, to a 401k, to an investment fund. Okay, it is not the same tool. It is a different tool in your toolbox to use for a different purpose. It is not your emergency kitty, right? Your emergency kitty, your emergency cash should be in a different account. It's not your infinite banking policy. Other investments, your real estate investments, your other businesses that you might own or invest in, different tools in your toolbox. Okay. So when people ask me, well, what's the interest rate for the whole life policy? It's about 5%. And they're like, well, that's very low. It's low. It's not as low as a bank account. It's better than most money markets right now, but it is steady, it is guaranteed, and it is stable growth. We all need that in our financial portfolio. Our investment funds are where we have the volatility, and it's where we have potentially higher opportunity for return, okay, and other investments as well. But I really like to clarify that for people, so we're not trying to compare apples and oranges. Let's compare apples and oranges to apples and oranges, if you will, okay? And there's benefits here. We are in a down market right now. The benefit of your whole life in a retirement scenario is, in a down market, you pull income out of your whole life insurance policy. You leave your investments alone so you do not start to harm the trajectory of that growth over time. In a down market, when you pull money out of those accounts, you're hurting yourself more than just that year. It is a long-term impact. And so being able to pull these different levers at different points in time based on what market, the market volatility and what markets are doing, is also extending the overall health and breadth of your financial portfolio. So again, it's how you use the tools and when you use those tools that can overall benefit you. Okay, example. So here is a client. This is she's an attorney out of California, actually. And she put a lump sum drop in of $30,000. And then she was putting about $25,000 a month in her policy. The reason she was putting that in is she was running the payroll for the law practice through her policy. Okay. She does not have any dependents. This her beneficiary is her trust. Her trust is going to pay for the care of her partner's disabled child. So that's what's happening with her benefit.
Julie,
Okay.
can you explain a little more detail when you say that they're running the payroll? What do you mean exactly?
Yeah. So, okay, so we loaded in $30,000 up front, right? So what she does is she takes a loan from her policy and she puts that loan goes into the bank. She pays payroll. Her business then operates, right? She has operating income. The operating income pays the loan on the policy. And then the next month, she takes her payroll out, puts it in the bank, pays payroll. Her business pays the loan off. It's just a cycle, just a continuous cycle, right? But her
So in that
short-term loan against her policy to pay every month, she's using that as a tool. Yeah.
No, it's essentially inserting one step in the whole accounting process, if you will.
So in that instance, is the policy written to the company versus her as an individual? Oh, okay.
It's her as an individual, and then she loans that money to her business. And then, I mean, it's just, that's the process by which she's doing it.
Okay.
Yeah. Yeah. And then the trust that is the beneficiary, it's just it's a trust that has the child, you know, because it's a disabled child. And so when she is to pass away, the death benefit will go into the trust. And then that death benefit will pay for the care for the disabled child for the remainder of the child's life. Okay. And so she pays in, you know, the $24,000 a month. So you can see, you can see here that her premium shows $326,000 for the first year. That's because of that $30,000. The remaining years is $296,000. Now she is only paying for 10 years. After 10 years, she's done paying into this policy. Okay, that's how we set this up as a 10 pay. So her cumulative premium, and typically in these policies, in year 7, you have broken even. What I mean by break even is your investment into your policy, your cash value has now is now higher than the investment that you put into the policy. Okay, because insurance companies will capture all of their fees up front. In those first 5 years, they're capturing all their fees. Okay, so after that period of time, that is when your growth starts to really kick in and you're going to see a big difference. Okay, so that's why I have this line highlighted. So her cumulative premium is $2.4 million. Her non-guaranteed with her dividend payout is $2.4 million. Okay, so she's past what she's invested in. And then after year 10, her cumulative premium, she paid in 2.99, so basically $3 million, right? So from here, her cash value just continues to grow. She's not putting any more money in the policy. This is growing because of the dividends being paid and the compounding growth. Okay. So within 30 years, she's essentially doubled her money in her policy. She's gone from 3 million of an investment to 6.5 in her non-guaranteed cash value. Okay. So that's the power of how these policies work. All along this time window, she's pulling money out, putting it back, pulling it, or, loaning it against and putting it back, loaning it against and putting it back. And so that's one example, right? And so you might be saying, I don't have $25,000 a month to put in a policy. That's okay. So this is the actual policy. And do you see here where it says MEC no up here? This is one of our key indicators. We have to make sure that that says no.
So Julie, on your example of the payroll, is that fairly true for any reoccurring standard? Like if I have a business that had, surprise, surprise, we have a portfolio of real estate that has notes against it. So we have reoccurring monthly expenses that are pretty fixed and standard. Yeah. But we also have income that covers that. So I could borrow to pay the notes and do that every month. And then
one of the best things to do in here is if you are the kind of person that you're not going to let your taxes get paid out of your escrow, right? That you're like, no way, that the mortgage company's not going to make money on me. I'll put that in the bank and make money. Is to pay your tax bill into your policy. And then at the end of the year, when you need to pay your property taxes, take it out of your policy. And the next year you're paying back, and then you take it out. So taxes is a beautiful thing to run through your policy. Any type of rent, mortgage, car payment, any of those normal, that's one of the ways that we help people on debt elimination is we teach them how to run those things through their policy. And it's kind of like using the snowball effect from Ramsey.
Yeah.
But you're doing that in the policy. So at the end of the day, you get all your debt paid off, but you have cash then still ready to use again, right? In his process, you don't have cash at the end of the day. You're out of debt, but you don't have any cash to use anymore. And so in this example, you're running it through your policy, so you're getting yourself out of debt, but then you have cash at the end of the day to reuse again. One example, we're working with a family. She's a physical therapist, and he has his master's in sports medicine, and they came out of college with $150,000 in school debt. And then they had a home, they had a mortgage, and they had 2 car payments. So they were projected to be out of debt in 33 years, and leveraging a policy and a process, we're going to have them out of debt in 13, completely paid off, school debt, house, their cars, everything's paid off in 13 years versus 33. So it can be a really powerful tool for that as well, not just in a business. Okay. So a second example is this client dropped in $5,000 lump sum at front, and then they're paying about $1,000 a month in their policy. So again, we're at year 7 where we're breaking even, and or close right at. And then again, they are paying through age 71 is when they kind of stop paying into it. And so they have a cumulative premium of $255,000. And so, by age 71, they have close to doubled their money as well, right? And then again, even if you finish paying in, you're not paying in anymore, your dividends are continuing to build your cash value and your compounding growth in your policy. So that continues to grow. Now, some people are very sensitive and they want a certain amount of death benefit, right? They are combining their insurance and they want a certain amount of death benefit because they may be a relatively young person and they might have young children, a house to pay off. They might have a lot of debt that they want to make sure it's covered for their family if something's happening to them. So the death benefit is important. So then we manage what they want that death benefit to look like or what they might need to have if something were to happen to them on top of what we're doing in their cash value. So again, everybody's goal is different. What we're trying to achieve is different. So we run your policy based on your goals and your desires. Okay, this is the policy on that specific one with the $5,000 drop in. You can see that here. And then the $1,000 a month in premium essentially. And so again, no MEC. And this just says standard standard non-tobacco. This is the standard is the rating that you get. So this is going to be standard, preferred, super preferred, or table, right? Table A, B, C, D, or table 1, 2, 3, 4, based on the medical piece. And then non-tobacco, if you don't smoke, if you do smoke, this will say tobacco. If you do smoke, cigarettes, vapor, chew tobacco, smoke a cigar, smoke a pipe, that's all tobacco, and that will have a higher rate of insurance, just FYI.
So once we start with a contribution number, can that be increased over time as, you know, as our needs change, as our business change, so to speak?
So that's one of the structural pieces that we would have to talk about, right? So we have to build in room for somebody to add additional premium. It can be done. We just have to build that into the structure of the policy from the beginning. It's not something that can be added later if the policy doesn't have room for it, right? If that death benefit to cash ratio doesn't have room for a lot more cash, then that ratio is going to get off and it'll become a mess. So that's where having that conversation up front, kind of thinking the long-term strategy, because again, infinite banking is a long-term strategy. It is not a get rich quick. It is not a short-term strategy. It's a long-term play. And so kind of thinking through that up front is where we would build that in. Now, every individual can have up to 100 policies, okay? The way that we look at that and the way the insurance companies will look at that is they'll add up the death benefit, and the death benefit total needs to be pretty on par with your net worth. And we do a projected net worth. So say you're 35, you know, we're going to project what your net worth is through your life. And that's how we're going to look at what your total death benefit looks like, right? With all of your policies added together. And they're going to do that whether it's an infinite banking policy, a term policy, an IUL, or the disability policy. I mean, all of those things kind of get lumped together as we look at total net worth versus total death benefit. So just FYI on that.
So,
okay.
Julie, you know, those premiums kind of freak people out, I think.
Yeah.
Freak me out a little bit. So as my business is borrowing money and paying back, you know, plus interest, plus principal, is some of that gain being applied to that principal? How does that work? Or is that just all additional money?
So when you have a loan, when you're paying a loan back, your loan payment is on top of your premium. It's in addition to your premium, okay? And the interest that you pay to the insurance company is not impacting your policy at all. It's not benefiting it or negative or being negative to it. Paying the principal back is what brings your policy back whole, if you will, from all the cash that's available. Okay. The way that you get benefit from your policy is the dividends and the compounding growth. That is where your benefit comes from. Okay.
Yep.
Okay. So, question. I'm done talking.
Julie, are you in the REIN?
Yes.
Okay, so that's how you reference Kelton, because you heard this. Mm-hmm. And he also said like he has one for every one of his kids, but you did say that it's not applicable to under 18. Is that correct? Mm-hmm.
Yes, if he has policies on his children, they are likely, well, they have to be kind of an indexed universal life.
So an IUL.
An IUL or a whole life that is not structured as an infinite banking policy. That is the only way
Gotcha.
You can have it. Infinite banking whole life policies cannot be written on people under 18.
Okay. Because I think he also thought about or mentioned something then too. You could borrow against theirs because you're the owner of that policy.
It's just like if you are uninsurable and you do a policy on someone else. Now, the only thing is if you do a policy on someone else, you have to be able to prove what's called insurable interest. Okay. So taking a policy on a business partner, your insurable interest is if something happens to them, it will have a negative implication to your business, right? And you will have to either find a way to supplement their role or potentially buy out their family or whatever the case may be, right? So that's your insurable interest on a business partner. Your insurable interest on your child is, of course, you know, it's your child, you know. If you took one on your sister or brother or a sibling, right, you would have to show insurable interest, whether that might be that your siblings are intended to take care of your parents long-term in life. And so if something happens to a sibling, it would have a negative impact on your parents' care, right? So that could be one insurable interest. So we just have to talk through what the insurable interest is on someone else if you want to do a policy on another person. It's not that you can't do it. We just have to prove that insurable interest piece.
Thank you.
You're welcome. The other thing I want to call out to you is Kelton talked about borrowing 95% of your cash value. Contractually, that is absolutely accurate. In your contract, you can take up to 95% of your cash value.
Yeah,
If you take,
earlier.
if you take 95%, and you don't pay that back, your policy will collapse. Your policy cannot handle having a 95% of the cash value out in a loan with accruing interest over the life of that policy, assuming you're taking it out not at the age of 92. Okay, assuming we're in the process of using the policy. So what I guide most of my clients to is if you have a fear or a concern that you will not be able to pay a loan back, then do not take more than 85% of your cash value. If you are confident that you can pay that loan back, then take up to 95%. But just know the risk. If you do that and you don't pay that loan back, you have a risk of losing your policy because it will collapse. Okay, so I just want to educate that as well, because that is a differential that you just have to be aware of what can your policy handle from an unpaid loan.
So Julie, a couple questions here,
Okay.
and I'll do them in pieces. How do people sign up for an insurance policy on IUL?
The same way, we get some demographic information, those same questions that I talked about for the whole life, and then we will run illustrations with certain companies, and then
Do they reach out to you? Do you have a
you can
email?
just come reach out to me. Let's see. So this has my phone
There you
number
go.
and my email address, and then that's my insurance company's website.
I'm gonna take a picture of that.
And so, yeah, you can call me, text me, or send me an email, either way. And I can either send the little form out that you can answer those questions, and then I can go from there, or we can have a quick conversation to talk about your situation individually, if that's what we need to do as well. Either way.
Yeah, and then what are some of the minimum loan sizes? So I mean, the minimum premium sizes on a monthly basis.
So, okay, so the example of the one that I told you that we were helping them get out of debt because of the student loans and that piece, they're paying in $200 a month. Okay. But their policy is very small. So we are not talking about huge cash values. It is literally, we're doing a rotation process for them to get them out of debt. Okay. For infinite banking, to have really any kind of depth of cash, your minimum should be $500 a month.
Okay.
That's really the minimum. And I would really recommend $1,000 a month. And we can talk about how to leverage that process of running maybe one or two expenses through it. So it's not just pure cash out of your pocket that you're not doing something with. But really, when you start talking about a sizable, cash value to do anything with in the early years, right? If you're looking at this to say, okay, in 10 or 15 years, this is what I want to be able to do, no problem. That should be fine, right? But if you want to do something significant with this cash in the first 5 years, the first 10 years, then we need to be loading that policy in.
So again, this isn't something that we're going to start and next week or next month or 3 months from now, we're going to go out and borrow against it to buy a house.
Unless you have that cash sitting in a money market account, sitting in a bank account, really being untouched right now, unused right now, then I would say, let's talk about a front load and let's get that loaded in. And then as soon as your policy is enforced in 7 days, we can get that cash out, right? And you can start using it for purchasing property. So it's really based on what each individual has available and how they want to do that.
So any of us that do have a pretty decent business where we have consistent cash flow coming in and consistent cash going out, we should probably set up a one-on-one meeting with you and just say,
Yeah.
how do these numbers work and what kind of program can we build
Yeah.
around this?
Yeah,
Perfect.
absolutely.
Perfect.
Yeah.
And again, I want to copy your information, maybe let you talk just a little bit longer. I want to drop your information here in the side chat so people have it.
Okay, perfect. Perfect. Was there any other questions? Any thought?
I actually have.
I can't wait to talk to you on Monday.
I know. Yeah, we have a discussion on Monday, Cindy.
Yeah, I know. I'm sorry. And there's the dogs. I'm gonna mute myself again.
Julie, can you hear me?
Yes.
Okay, great. I apologize. I was a little bit late jumping on. I had an appointment. And if you answered this already, I apologize. I have a question. At first I was going to go the self-directed IRA direction. And then I started learning about whole life insurance. And I've been doing a lot of homework on it. But I just wanted to check, is there a benefit to having both? Or would it be just beneficial to have the whole life if you're going to use it for mainly real estate investment? Or can you?
Yeah, personally, I think it's beneficial to have both if you can, right?
Okay.
Again, there's a self-directed IRA and having a property trust. There's several benefits to those two things and to leveraging that strategy as well as leveraging the infinite banking strategy. So,
Okay.
I think there's a place for both of those in your situation if you can manage that.
Okay. And I apologize. There's one other question. Can you use I thought I heard somebody that said they used a traditional IRA to buy land. Then they took out a conventional mortgage for the home and they Airbnb'd it. But they did something where they used something with the custodian or whatever. So they didn't have to transfer it to a self-directed IRA. Does that make any sense?
I am not aware of how that would happen. I would really probably refer you to a financial planner or a tax and trust attorney. You know what I mean?
Okay.
I think I don't want to answer that question because I could probably guide you the wrong way.
Oh no, I was trying to understand that better because I thought, maybe I don't have to transfer it to a self-directed, but I didn't hear more than that. And I thought maybe someone could elaborate. I'll check with my advisor.
If you want to send me an email, I have a really good attorney that does self-directed IRAs and land trusts.
Okay.
So I'd be happy to send you his information. You could pose a question to him. That's who I would go to if it were me.
Okay. I appreciate that. Thank you so much.
Yeah, absolutely.
Hey, Julie, I also had a question. Just to clarify, this is like you're talking about the whole life insurance that it's dividend paying, right? The one that Mr. Nelson Nash discusses in his book, right?
Absolutely.
Okay, excellent. So once you get this started, maybe like I'm now learning about it and I'm in my 30s. But I know that my growth potential is going to be higher. I'm the one that asked the question about if you start with, let's say, $1,000 a month, can you work it into the point that, because I get bonuses at the end of the year, and I like to like kind of direct my bonuses to buy up more insurance, you know?
Yeah.
So is there a way that could be planned?
Yes, we can structure that in. Yeah, we can structure that into it. And so it's just in the way of how we build it and how we build that illustration. So in your contract, it allows for a little more runway, is how I would say, a little more runway on the cash in your PUA. And so it's just how we structure that. So we can build that way.
Okay, excellent. And also, if you, of course, according to his book, I literally just finished reading his book. So everything that you're talking, I'm like, oh yeah, this is what he was saying. Okay, now it's clearer.
Yes.
But in the book, he said, if you borrow against your policy, you always have to, like, if you're paying back, you have to pay back as if you were doing it. If possible, you should pay higher than the market value, just so that the extra that you put in, it's going to be able to buy up more. And then you're going to see like the extended benefits later, instead of paying yourself like the bare minimum.
Right.
Is that what your company also does?
Yeah, that's it. When you pay yourself back from a loan, you are determining that payback schedule. Okay, the insurance company is not dictating that to you. And so this is where the discipline comes in, right? So you can pay that back as quickly as you want. You can take 5 years to pay it back. You are determining your payback schedule. And so that's where, that's where people can get themselves in trouble if they say, well, I'll pay that back later, right? And later never comes. So so that's a structural thing, but it's setting those payments up just like you were paying a bank back. That's where you're going to get the benefit.
Okay, so pretty much once you borrow against it, there's a kind of interest that you are charged, right? If you borrow against it, right?
Right.
So me as the contract holder, let's say I'm being charged 8% for borrowing for my policy. If I'm paying back, do I have the right to pay back, let's say 10%?
You can
Or
pay back
no?
10%. If you want to pay that back, then that means that you're just paying a little more on the principal.
Right.
Then that little bit more on your principal would go into your policy, and then the interest, the calculated interest, is going to go to the insurance company. But again, we have to make sure we're structuring your policy to hold extra cash, so it doesn't become a mess. So again, it comes back to the structure and how it's built.
Okay, so it all depends on how you are structured from the beginning.
Yep.
And it goes in there. Okay, so my next question, I'm sorry, I have so many questions.
No, these are great.
So my next question about it is, you're talking about how these policies go perfectly if you already have a trust set up. So in my case, I'm now in the process of actually establishing my trust. Do you think I should wait to finish establishing my trust before I start my infinite banking policy? Is that the best way to go about it? Or I can start or I could just start the insurance because time is of the essence. And as I get my trust established, we can just link it up.
Yeah. What we do is we would just go in and do a change of beneficiary. It's very simple to do, and we would change the first level of beneficiary to the trust, and then you could have contingencies after that, or you could have a first level and then your trust is the contingency. So we can talk through what you want to do, but you would just do a change of beneficiary form. That's all it would take.
Okay, I'm sorry. Really, one last question. I promise this is the last one. So when you talk about running the payroll through your policy, I just wanted to get a clarification of that. Let's say because I think somewhere in Mr. Nash's book, he was talking about how because you are setting up your own bank, I mean, now when we get our paycheck, it straightforward goes to the bank. If you are with Bank of America or whatever, there's a way that you can structure it, especially if you're working for yourself as a business, where you are paid directly into your policy. Am I making that up, or that is?
Yeah, we would have, I'm not aware of a scenario that you can have a payroll check go straight to your policy. So it would always go into a bank, and then you would make the choice to either pay that into your policy via a premium and or a PUA. But from a personal paycheck standpoint, that I'm not aware of a scenario that it will pay directly into a policy.
Okay, so it could go to a bank first, and then you determine how much you can put into your policy.
Yeah, and you can set that up as a direct payment, right? Like a ACH kind of thing, but not straight from a payroll company.
Okay, all right, excellent. That's all with my questions. Thank you so much.
You're welcome.
And again, Julie, I put your contact information in the side chat for everybody.
Okay.
So.
Perfect.
And you're also part of the Creative Real Estate University Facebook group, so they can find you there.
Absolutely. Yes. And I'm on Reen. So if
And you're on
anybody,
Reen as well, yeah.
Mhm,
So
mhm, yeah. Yeah. I'm on this real estate journey right along with all of you.
So what came first, your real estate journey or your insurance journey? Your insurance journey came first, correct?
Yes.
Yeah.
Yeah. We've been doing that for several years. And so, and I had wanted to start, like we put our real estate LLC together in 2019,
Okay.
but I was busy building the other business and getting all that going. And so we didn't do anything with it. And so finally this year I told my husband, I said, that's it. I'm jumping in with both feet and here we go. It's going to happen. So now we're doing it. I joined Reen in May. So
Oh, fantastic.
yeah. Yeah.
So, and I don't mean to get off track, but in your real estate journey, did you go to the Reen Live event that was in Dallas just recently?
I did.
Yeah, yeah.
I did. Yeah. Yeah.
Perfect.
It was so awesome to meet so many women that just strong and passionate and excited, and you know, it was, you draw from their energy and their excitement. So it was super fun and great to meet so many people. That's where I met Cindy and just several people on the call actually, but it's been great.
Yeah, Cindy said we're gonna have a Creative Real Estate University live event just so I can come.
I love that. Yeah, my husband feels
Oh,
left
yeah.
out too. He feels very left out.
You know, and it's wonderful with so many energetic people like yourself. They bring in so many different backgrounds and stories and knowledge, all wanting to do similar things, right? They're
Oh,
all
yeah.
slightly different, but they're all similar.
Yeah.
And just to have that sharing attitude that can bring in these little pieces like this that says, yeah, we're all going to go buy real estate, right? We all want to have this journey, but here's
Right.
a different path or different tool to assist you. So we greatly
Yeah.
appreciate your time today.
Absolutely. It's fun. It's so fun. I could talk about this for hours. I just think I love helping people figure this out and put it in place, and you know, at least answering questions for them. Right. So there's several other people in Reen who do this as well. And that might be a better match for some people, but I'm happy to answer questions anytime.
You're singing my song, Julie.
Yep.
I'm the same way. I just love answering questions and being a source of information, and love to helping people along their journey. So
Exactly.
Yeah.
Exactly. So
again, thank you
reach
for
out. I'd love to talk to any of y'all.
thank you again for joining the group. Thank you for bringing
Absolutely.
this information, and let's keep working on them houses. You know,
I know. I've told my husband I need to fill out the forms for y'all now that we've gotten some of the other information. So see we can make
Perfect.
that work.
And one last chance for anybody have any questions. I see there's a couple of chats. I think people are saying thank you. And then thank you, Elizabeth.
I have a
for
quick
posting.
question.
Yes,
Are the
please.
slides available to download?
Are we all going to post a recording, Shane?
I will post a recording. Yes.
No.
Okay.
But
Oh,
she
I just was thinking the slides separately, but if it's in the recording, that's great.
Okay.
This has been wonderful. Thank you, Julie.
You're so welcome. Y'all have a great evening.
Thank you, everyone.
You as well. Bye-bye.
Bye-bye.
Thank you. Bye-bye.
Thank you, Julie.
Thank you.